Okay, so it's my third video. So hello guys. Um, Basically I'm gonna break down kind of the casino take, risk to reward, edge a little bit more in depth with some more in-depth examples, and kind of get into the numbers of everything, as well as talk about the bullshit of trading, because there is a lot of it. Some of it's self-inflicted, a lot of it is social media and a whole bunch of that shit. So the majority of people on social media, let's just start, don't trade. There are a few that do. I would probably say like 15 to 20% actually trade. And that's another thing. I'm not against courses either. Like I'm totally for courses. Courses are ultimately like what made me like a profitable trader after applying what I learned, and then basically applying what I learned on the charts, zooming in, creating zones and stuff like that, and that application ultimately led me to be profitable. I'm not as profitable as I want to be. I don't think anyone is. Everyone wants to win every trade. But the realistic point is that is something that will just not happen, and that is nothing you can control, because the market does whatever the fuck the market wants, and you're wrong and it's right. So the approach that I have, I'm not going to get into it. I like to buy retracements following trend. Retracement is simply when the price moves up, I try to get in when the move is basically retracing back here to then continue to take it up. A great example of this is scrolling back at the daily time frame, Euro USD. So one thing you will notice, and one thing I believe it's Dow theory or some shit like that. Some theory. Let's look this up really quick. Dow theory. Dow theory states the market trending upward is average advances, whatever the fuck, can even speak English. Essentially what it's saying is trends tend to continue more than they don't. What I'm saying is, if you close your eyes, you look at a market that is doing this, the next time it's probably going to do this and then do that. That's the ultimate theory, like that Dow, I guess, put forward. It's way more complicated, Dow theory, all this shit. It's not that fucking, it's pretty simple. Essentially, markets that are moving and trending upwards like this tend to continue doing that more than they don't. Meaning you're not going to get a lot of times where the market will do this, and then this, and then this, and then this, because this would be a forever expanding market, and that's not how it is, clearly. It doesn't mean that markets are also going to do it in a pretty way, though. Like, it can do this, come back, do a little bit of that, and then fall. There is no one size fits all. Not every single thing is going to be textbook. You're not always going to get a market that perfectly drops and then comes back and then drops and then comes back. Sure, there's those opportunities, and obviously I capitalize on them every single time, but that's just not how it works. If that were the case, again, like I said earlier, everyone would be a millionaire. So what I do is I plot POIs, points of interest, my own way, using a variety of different methods, which in the coming videos I'll kind of break down and stuff, but we're not there yet. And I try to basically buy the retracement, meaning the move back. We're going here and we're coming back. And I try to get in here, and then my target, my stop loss is over the high, my target is the low. And so you take a look at this, we see it's a 1 to 2, and I know from my data that my 1s to 2s, some months hit 40%, other months they hit 60%, some months I've hit 70%, but this tends to be around a 1 to 1.5 risk to reward, meaning I'll risk $100 to make 150, or I'll risk $100 to make 200. There are very small opportunities I'll risk $100 to make 300, and there's some opportunities that I risk $100 to make $100. Ultimately, I know my data, ultimately I know my setup, and ultimately I have conviction of how to trade based on this kind of example that's very basic, the way I showed you. And if you can capitalize that once, twice a week, once, twice a day, multiple times a day, multiple times a week, multiple times a month, you can ultimately make money. That money obviously is based on the amount of capital you have. you're not going to be able to necessarily take $100, your full account balance, and risk it once and then turn this into $10,000. Sure, it's possible, it's not probable, if that makes sense. If you have a 50% win rate at a 1 to 2, risk 100 to make 200, half of the time we're going to lose this trade, but the other half we're going to win too. So knowing that, taking $100 of your whole entire account balance and at least not splitting it up into at least $10 or $5 increments is pretty dumb, because there are times that, you know, it's going to hit tails 3 or 4 times in a row and you're going to lose 4 or 5 trades. Like, it's you don't have the sequence of which is going to happen. You just know that long term you're a profitable trader, and so you're going to have crazy winning streaks of fucking 6 to 8 trades where you just like feel unstoppable, and then you're going to have the same exact stuff where it's 6 to 8 trades of just minus, negative. There goes your money. And so controlling risk is ultimately the thing that's going to keep you in the game, and the amount of time you're in the game is what's going to turn you profitable. Obviously, saying that you're going to be profitable is not necessarily the case. I can't like say that perfectly for everybody, but if you spend enough time doing this, you'll catch on to things way better than people that stop doing this. I mean, obviously you pick up things, like I'm a big gym goer. So I mean, I pick up things, ways to do workouts that I would not have known starting, and it's simply based on the amount of time, experience watching other people, researching myself, watching videos, a whole bunch of shit, watching videos of myself doing different workouts and stuff like that. So ultimately it's time and experience that you are going to get. That is something you cannot buy from somebody else. Someone can't sell you experience. They can sell you strategies. You basically put it to the test, collect data, see what's working, see what's not, crunching the numbers. It's a painful start, but ultimately it is a rich one if you continue down this path. Most likely. Again, it's not for everybody. So I'm going to get down really quickly into the coin flip thing a little bit deeper, and kind of get into the casino thing and my approach to the markets. So in this, the only thing you have to worry about is if you take random trades 1-to-1, risking 100 to make 100, the only things that'll slowly kill you, basically slowly bleed your account, are 2 different things. It's called slippage. Slippage, or it's actually 3 things. It's spread, but I'm thinking spread / slippage, and then commissions, COM. As you can see, I'm not a teacher. I write like a doctor. But ultimately, spread and commissions / slippage are going to be the thing that will slowly bleed you. But good thing enough, in the futures market, which I personally trade, commissions and spreads are so small, it is something I don't even need to pay attention to, basically. Like, if I were to risk $100, I'm really only gonna pay attention to like $2 to $3 of the cost of doing business between slippage, spread, and commission. And because spread is so minimal on futures, you don't really need to worry about it. And spread is essentially, really quickly, for those people who don't know and don't want to Google it, spread is the difference between the buy and the ask, meaning this between the sellers and the buyers. It's basically if you take a look, let's go on the 1 minute. You take a look at this red and blue line right here. You can see that there's a little bit of a discrepancy in price. There's this buy, or there's a spread, or the bid, and then there's the ask here. Easily put, if we were to market order, we wouldn't get filled directly at the price line at 108,124. We would get filled at the spread line, which is up here. So you're basically taking a little bit of a hit to get filled. That's essentially all spread is. But long story short, it doesn't take a lot to be profitable, but it doesn't take a lot to be profitable on the surface, because a monkey could close his eyes, place buys, sells, buys, sells, buys, sells, buys, sells everywhere on the chart, and ultimately, if he didn't pay attention to spreads or commissions, he would be a break-even trader in the long run, same as a 50-50 on a coin flip. what's really nice about this is all we need to do, like I just explained Dow theory, is that same exact concept, but following trend. So we see something going down like this. Let's go back to the example we had because it was a really good one. We see the market going down over here. Trend based on Dow theory says that we will continue down, meaning we're going to continue making higher highs or lower highs, lower lows, lower highs, lower lows, lower highs, and then ultimately lower lows. And we're basically making this trend pattern of like this. If you were to place a 1-to-1 randomly, already as a trader you have an edge, because if you know for a fact that trends tend to continue versus not continue, and you know that if a monkey places random buys and sells everywhere, and you just follow the trend, taking sells, following it, you already have an advantage to people that aren't doing that. We know this goes down more than up when it's trending down. So if you were to take your 1-to-1s and place them like randomly on this, sells because it's going down, you're not going to be buying this, you will ultimately make more money than you will lose in the long run. There's obviously a whole bunch of varying degrees on how you want to like enter and stuff like that. You're not actually going to place random trades, but that's kind of how you get an edge in the market. Obviously that edge isn't a lot. There's a whole bunch of ways to kind of refine what I'm saying down to a specific entry targets, specific stop loss placements and stuff like that. But ultimately you will slowly make money in the long run. You'll be a profitable trader doing that. And because it doesn't take a lot and it seems so simple, it's kind of why people overcomplicate it. The thing that's a little bit hard to kind of teach people is experience. Just because what I told you, there are going to be certain pullbacks and stuff like this pullback right here with an entry, something like this is a lot prettier looking than something like this with this whole bunch of chop and push up, and this is like less desirable than something like this. And I can simply say that because one, I'm looking at it and it's hindsight, so don't take my word for it, but in real time I can distinguish better looking entries that are more high probable than worse looking entries. That doesn't mean the worst looking entry doesn't work. It just means that it's just less probable. So if you're risking $100 on a high probable setup, it makes sense to risk $50 on a low probable setup, or whatever you kind of come down to. Ultimately, it's not the dollar value that matters. Turning $100 into $200 is the exact same as turning 10,000 into 20,000. It's not a profit game. It is a capital problem. I mean, you may only make 20% a year, but if it's 20% a year on $15 million, that's a pretty big chunk of change. At least I don't know about you guys, but for me. So yeah, I try and get in on the retracements following a trend. I use multi-time frame analysis, meaning I won't be looking at just this trend going down. I will also be seeing, okay, this one day is going down. Let's see at what point the 4-hour also starts trending down. Because if you take a look at this is going up, and then it starts to go down. Basically, I'm trying to match the lower time frames on the 4-hour and the 1 day on the higher time frames to get the best and most probable setup. It's not as peachy clean as that. There's a little bit more that goes into it. Actually, a ton more that goes into it. But essentially, I'm trying to match lower time frame, faster paced candles to match it with higher time frame, slower paced candles, to basically follow the trend on both the lower time frame for the entry and the higher time frame to basically get in the most probable setups. I'm trying to follow the trend at all times. There are times I take counter trend, meaning stuff is going down and I'm buying, but that is not because it's something you should do in the beginning, but something that takes a lot of experience to kind of do. There's also times I'm wrong about the trend. It's just part of trading. You're never going to get 100% win rate. If anyone tells you that, don't listen to them. Don't buy the algorithms. Don't buy the free webinars. There's only a few people that I would actually recommend, like truly, for their course. But then again, you could find all of it online for free. In the end, it's intuition, it's experience, and it is a proven setup with data behind it, and the intuition / experience backing that. Because I could tell you to buy pullbacks all day, but if you don't know what you're looking for, and the experience doesn't play a part into it, you're ultimately not going to know what to do. I mean, obviously in hindsight, it looks like, oh, comes back right here, should have sold. Oh, comes back right here, should have sold. But in live trading, that's not exactly how it works, and that's just kind of how it is. So this is all hindsight. I can show you live setups and show you guys kind of live stuff. I mean, let me pull up TradeZilla right here. Let me log in really quick. Yep, there you go. Dashboard. We open up all my funding stuff, and this is the P&L so far of this month. A lot of it's on funded accounts, on evals, and I'll explain what that is later. But so far, good profit factor, good win rate, good amount of money, got a few payouts, passed a few challenges. On board to basically opening up a personal account pretty soon with $10,000 or $15,000 to kind of continue to scale this up, because right now I'm basically just trading prop firms, and prop firms I'll kind of dig deeper in the future. It's basically a way to get capital and to trade capital without actually having any of your own money, and you're not liable for the risks and all that stuff. I'll explain it later. But ultimately, I did blow two demos. I lost a PA, but a PA is basically like a funded account, but I'm doing pretty well across all accounts, and it's nice to finally see all the work kind of pay off. Same with my roommates. My roommates are new at trading. They have like 4 to 6 months trading total. They've had a few withdrawals, and ultimately, like, I don't know, this shit's life changing if you actually spend the time to do it. And I mean that from the bottom of my heart, because the amount of hours and shit and the money I've lost, like, whew, I don't know. It's definitely an emotional thing. But yep. That's trading. I don't sell shit. I just kind of give out free information. I enjoy teaching, sort of like, sure, all your elementary school teachers were like, oh, like, we don't do it for the money. Clearly they don't do it for the money. That's not to say that I won't open up a course or something in the future if this ever actually gets any traction, because as of right now, I'm pretty much talking to myself. And I don't have any views, no subscribers, but it's not a big deal. I'm not really here for that. Hopefully I can look back in my Senna or P1, whatever it is, Lambo, and kind of see like what I was going through at the time, and the pinnacle moments of it, like, I don't know, like the gears turning, the light bulb moments, the home run hits and shit like that. Anyways, we all, whether you're profitable or not, you all have shitty days, and it's a never ending tug of war with yourself in the market, because no matter the decisions you make, no matter the bias you have going into it, ultimately does not matter if shit is going the other direction. So that's that. Enough little words of wisdom. Shout out to Words of Wisdom. Love that podcast. But anyways, toodles.